right, we're just getting the participants coming in now. Just give them a sec. It's coming in at a slow from the waiting room. All right, numbers are still going up, so I'll just wait a minute. Hi, everyone. My name's Brad Dunn. I'm just waiting on people clicking in to the webinar. We've got quite good numbers and they're still going up rapidly, so I'll just wait a sec. All right, seems to have slowed down. We won't want to wait forever. So hi, everyone. My name's Brad Dunn, and we're here today to talk about the Westbridge Total Return Fund. Let's get straight into it. Okay, first up, I'd like to say that I'll be joined today by Damien Collins, who is our chairman, who's got over 30 years experience in property developments, and of course was the former president of REWA. He's also the managing director of the MW Group here. We're also going to be included with Simon Worth, our head of capital transactions. He's got over 20 years of commercial property experience across Perth, Sydney and Melbourne. He's held senior roles with both global and national real estate investment trusts in both valuations and in capital transactions. And finally, we've also got Alex Lambert in the pink shirt there, who is our head of commercial funds with over 20 years experience in the industry across both United Kingdom and Australia, including senior positions within private property portfolios and one of the largest property service providers globally. All right. First of all, we'll just start with some quick housekeeping. It will be recorded, so anybody who can't see the whole thing or wants to hone back in on another part, we will be sending out a link afterwards for people to watch at a further point. We'll be showing you through in a second how to run through the Q&A questions. The presentation will run through. Feel free to put your questions down, but we won't be answering them until the end. And this is the screen. So everyone will see there will be a Q&A button that you can select on the bottom there. Just type your questions in. I'll be reading them out at the end and getting the guys to answer all the questions. Please note too, last time there was quite a few questions that we didn't manage to get through to. So if possible, don't click anonymously unless you really need to, because that way we can follow you up afterwards, give you a call and answer any questions you have. All right, so the agenda, we will be initially running through what is the Total Return Fund. Damien's going to be giving an overview of it, along with some context about what's happening in the commercial property sector and how the market's performing. Then Simon's going to be providing an overview of the latest asset, which is going to be coming into the fund. We're then going to be following through to Alex, who's going to provide an overview of how the fund's performed to date and our plans of the fund going forward, followed by our question and answer section. First of all, the standard disclaimer, just so everyone's aware, information is going to be of a general nature, doesn't take into account any of your personal circumstances. Always seek personalised advice before making the decision to invest. And for full information on returns and risks, please refer to the Fund IM or Information Memorandum. We will be sending them out, hopefully around about the 6th of September to everybody who's on this webinar and has registered interest in our funds. However, feel free to reach out to anyone in our key relationships team to make sure you've got one coming out to you. All right, first of all, a bit of an overview of Westbridge Funds Management. We've got over 20 years supporting investors here, of which we've had 60 mil worth of cash paid out in financial year 2024, of which part of that was 42 mil in commercial assets, which we've sold. In particular, there was the sale of a warehouse facility in Bale Road, Canning Vale, which closed out that syndicate and returned a total return to investors of 519%. And more recently, we've also had one in Marqueasy Street, an industrial asset in Kewdale, which delivered a 33% uplift on the purchase price in just 16 months. That was actually a part of our industrial total return fund, the first iteration of our bigger total return fund we'll be talking about today. As you can see, we've got a portfolio that's spread across all states. There is a bit, of course, in WA, not just because we are WA based, but because 4 to 5 years ago, we did feel that there was quite a bit of uplift and a lot of value to be bought there. And it was also quite heavily slanted towards industrial in Queensland as well. We made a decision quite some time ago, which I felt was the right one. Thank you, team, that we didn't go very heavy into the office sector. We felt that there might have been some risk over the past 5 years getting into it, and I believe that's worked out very well for all the funds that we're in. Let's get into the management team. So whilst we have the four of us on the webinar today, we have some strong backing from a very great leadership team in the background, and of course, many more behind the scenes, which aren't up on the screen there. Of note, you've got Alex Donkin and Jennifer Wakeman and Phil Anderson, who head up different departments within the company. Let's hand over control now to Mr. Damien Collins to provide an opportunity overview. And Damien, you have control. Welcome.
Thanks, Brad, and nice to be here today. And thanks everyone for joining us. So we're going to talk about this particular fund. We've run some different funds with different strategies, but when we set this fund up some 18 or so months ago, thereabouts, we saw that there was opportunities in the market with changing environment, changing interest rates, for taking on assets that needed a bit of love and attention, and we could value add to those assets and get better returns. So rather than a long-term fund where there's ongoing income and that's the strategy, this one is a shorter-term horizon. So we've been looking for properties that, as I said, we could value add to, that needed some love and attention, whether that be leasing resets. We knew there was some market reviews in the rents coming that we could put the rents up significantly and get some increased values that way. Some with some vacancies, and some with some value add, some construction and refurbishment to varying degrees. So the mandate for the fund was to target properties Australia-wide. So we've been looking right across the country, and the team will talk to you about those assets that we already currently have in this fund. So this fund already does have a number of assets, and we're adding one now. So you'll get to see, and when you buy into the fund, you get a share of all those assets, not just the current asset that we're purchasing. So we're targeting 10 to 12% internal rate of return, and internal rate of return is basically a combination of cash flow from the distributions and that we give out to investors, plus the forecast capital growth, and that's based on when we sell the assets and our forecast on what we might think those assets may sell for. So right at the moment, it's a blended fund, so we are paying out distributions and we are targeting around that 5 to 6% bracket. That has varied slightly through the journey of the fund, depending what the net asset value is and what the particular assets we have. But we are targeting around that range, and the balance of that fund will then be, as I say, targeting capital uplift at the balance as we add value to those assets and we exit them at the appropriate time. This fund is only available to wholesale investors, so you need to qualify under the Corporations Act, being a minimum net worth of 2.5 million or a minimum income of 250,000, and we need to get a certificate from your accountant to demonstrate that. So be aware of that. It's not open to all investors. I mentioned the value add strategy. It's about, the team will talk you through about the current assets and what we've done already. And sector and geographic diversification, as Brad mentioned, we've been very strongly focused on industrial over the last 7 or 8 years as we've grown the portfolio, and also we've been targeting neighbourhood and local service, retail, those types of assets, and we still see them as the best bet for certainly growth in the near term. Office market will come back one day, but we're not necessarily targeting that. Right now, we're targeting generally more of that industrial and more that local retail centre, and you'll see that in the asset selection that we've chosen. The minimum investment is $100,000. So, and the way it works, if you haven't invested in funds before, is you get a pro rata share of that particular fund. So in simple terms, if the fund had issued 25 million units and you were 250,000, that would be 1%. You get 1% of all the income that comes through the fund and 1% of any capital uplift as well at the end. So that's basically how it works. So That's a summary of it, of the fund. As I mentioned, it's targeting a combined total return of 10 to 12%. And we do sometimes get questions about what an internal rate of return is. That's rather than just using an average return. For a simple example, if you were saying if you got 60% return over 4 years, the average return is 15%. Internal rate of return takes into account where the cash flow comes in. So cash flow that comes in later in the journey, obviously generally through capital uplift, is discounted in terms of what the total return is. And that's why internal rate of return often sits a bit below the average return. So even though the internal rate of return is 10 to 12%, we expect the average return to be more than that over the journey. But internal rate of return is a common methodology used in certainly in property investing and forecasting. The distributions are going to increase to, they did increase to 6 cents a unit from July 2024. And look, that's down to the great work of our asset management team. Alex will talk about that shortly. Just managing the leasing expiries, managing our cash flows. Obviously, we're going to do some capital expenditure on some of these assets, and so that has been a good outcome. And we did see returns increase to 6 cents a unit from July 2024. Why is it a good time to invest? Well, look, we've been still buying through the last 2 years cycle, but very selectively. We bought fewer assets in the last 2 years than in previous 2 years, but there are some still really good opportunities. And one of the reasons is that the market had to reset. When we saw interest rates go up from near zero right now to where the Reserve Bank rate is sitting at 4.35%, the market had to reset in terms of, and while everyone knew there was rate rises coming, perhaps the market didn't anticipate the rate rises would be so steep. And of course, that means now that everything's generally in investment communities based off the risk-free rate, which is generally the 10-year government bond. And that's where benchmark expectations are for returns. So when the interest rates went up, and that was obviously due to the quite strong CPI numbers that we had during that post-COVID and post-COVID period when governments were throwing money around hand over fist, we did see those rates rise. But right now, we are in a market where we anticipate that we have seen the peak rates. Now, there's been some discussion in the last few months that rates, will they go up again? Will they not go up again? We certainly think, and the market's starting to come around to the idea that we definitely have seen the peak of the rates. Now, what happens is once the rates do go down, and we're certainly expecting a US rate cut in September. Once the rates do go down in Australia, I anticipate probably early next year, that's when you start to see more money come into the property sector. So we think there's still a good window of 6 to 9 months where there's still really good buying opportunities. We're seeing less competition than we used to. Having said that, it is, there is a few more people around who are buying, but and so we're certainly focused on the fact that the market has readjusted cap rates or yields on assets better than we could have got a couple of years ago. And that means, though, of course, if and when we do see rates go down, that they will also reprice, and that should give us some capital uplift as well. Importantly, we've chosen the right sectors also. We're still seeing really strong growth in the industrial market. We sit as a team, as an investment committee, looking at different assets, and it's quite sometimes staggering how under-rented a lot of industrial properties are. And that's given us an opportunity to know that, having better market knowledge than perhaps some others in the sector, and even the sellers, that we know that we'll be able to get a good reset when the market review comes up on those particular assets. I think it's another thing that's important, and this applies right across the property spectrum. We're not talking about residential today, but the same applies there. It is now the building costs across the country, due to obviously the very strong demand that we've seen, and inability to meet that demand from supply. Of course, what happens, everyone puts their prices up. Subcontractors put their prices up, builders put their prices up. So we've really seen a significant increase in construction costs in the order of 50 to 80%, depending on the sector. So that's going to really put a floor under where we see the rents likely to be. And we look at these types of assets, even in the neighbourhood centre type assets. Recently, we bought an asset outside of this fund, but just looking at that, the replacement cost to build that brand new, the rent you'd have to charge would be substantially higher. So that, to a large degree, it does put a floor under where we're likely to see rents, because any new competitors coming into the market to build more supply with those higher costs are simply going to have to demand more rent. So we think the cash rates are nearing at their peak. I mentioned that before, and certainly the rate cuts that we anticipate will support obviously more cash flow in our fund, because we do put some debt in those funds. And if those exit yields do come down as we anticipate, that certainly we'll see, as well as the value add, we'll see some capital uplift from the lower exit yields. And as I mentioned earlier, we are starting to see that there is more money starting to chase property. We still think there's a really good window to pick up assets, particularly the ones we're chasing here, where they've got some challenges to them. They're not just pure play passive assets. They're things that we can add value to through our expertise. And that's where we think there's greater opportunities right at this particular moment. Of course, in Australia, across all sectors, residential, we're seeing that huge population growth. Yes, they're going to cut it back a bit, but still we're seeing strong growth. And every person who comes into the country, there's more demand for industrial property, office property, retail property, and of course, residential property as well. So certainly a strong population growth underpins a strong property market. It always has, and always will continue to do so. And given what's happening globally, there's certainly lots of people who'd like to come and live in Australia. So we think it's a good time to be opportunistic. You've seen some articles in the Fin Review recently, and we're certainly one of those pros snapping up commercial property. I think once we start to see those rate cuts, the wave of money will start to come back in. So that's why we think the best buying opportunities between now and certainly coming into mid 2025, and certainly the sooner the better. The Total Return Fund, it's all about value adding. We've got targeting the right sectors. We've got medical assets, industrial assets, local service centre. We've been very cautious. The internet has changed a lot of things in the world. Certainly, it's changed the product retail, where now people can buy goods online and get them delivered to their home or office very easily. We've seen a lot of that. Hence, that's why we went heavily 7 or 8 years ago into industrial and continue to be in that space today, because there's a strong growth for that. But retail at the local area and the local community is still very strong. Your essential goods and services, your pharmacies, your certainly your local supermarkets, that's still very local. Your local and then your local services like your medical centres and your fast foods, quick service retail. Those are still very local. They really are negligibly impacted by the ad and rise of online shopping. And the office obviously is working from home's had another challenge to that, but we're not in that sector at this stage, certainly in this particular asset class. So it's taking advantage of that counter-cyclical market where we've seen the tenants, we've seen the investors pull out of the market a bit, some pressure into bigger funds to start offloading assets. We've bought quite a few assets from some of those bigger funds. And that's certainly counter-cyclical opportunities here for a little bit longer, but it won't be here forever. So I'm going to hand it over now to Simon, and Simon's going to give us an overview on the new asset that we've just purchased.
Thanks, Damien, and thanks, Brad. For our Total Return Fund, we have a strict asset selection strategy. We focus on acquiring properties we can add value through capital improvement, or where we can drive value through leasing and income growth. Our latest addition to the Total Return Fund is 122 to 128 Magnesium Drive, Crestmead, which we have acquired off-market. Some of the key strengths to this asset are its prime location within the industrial precinct of Crestmead, which has direct access to major transport corridors and conveniently located between Brisbane and the Gold Coast. It's a highly functional warehouse facility equipped with a 4.9 tonne gantry crane and expansive hard stand for equipment and material storage. It's a strategic 1.1 hectare corner site with 190 metres of frontage to Magnesium Drive. Assets with expansive hard stand and this property only has a site coverage of 30%, are increasingly rare in today's industrial market and are highly sought after by a lot of industrial occupiers, given the versatility of the property. The property is fully leased to Mirage Doors Australia, which is a wholly owned subsidiary of Assa Abloy, a Swedish-Finnish global company operating in 70 countries and listed on the Nasdaq Stockholm. The other important thing is we believe we are purchasing at 20% below replacement cost. And with significant increases we've seen in build costs and land values, properties of this nature are difficult to replace. Which now takes me to our value add strategy. We estimate the current passing rent is 40% below market. The Mirage Doors lease expires in February next year with a 5-year option. Mirage Doors have indicated they are committed to the property for the long term, which opens the opportunity for a market review in February 25 when the lease expires. This market opportunity allows ourselves to have significant rental uplift when we reset the current rents to current market. This rental uplift is targeted to provide immediate capital uplift as well as increased lease tenure. The property has a low site coverage of 30%, offering potential for future development or the ability to subdivide in the future. The high underlying land value of approximately 70% of the purchase price also underpins the value and provides further potential for capital uplift in the future. I will now hand over to Alex Lambert, Head of Commercial Funds, to give a fund update.
Right, thank you, Simon. To give a recap on the fund's performance to date, look, it's gone very well. It's gone as planned. We've certainly been able to slowly increase those distributions over time to date. To run through the assets, so the first asset we purchased was in Adelaide, just outside of the CBD. This is anchored by a First Choice bottle shop and a tavern. And Simon actually worked with the tenant in due diligence and was able to extend the lease from the due diligence period to get an extra 10 years on the tenure. Bear with me just a second, the slide's not coming up. There we go, thank you. So effectively, the purple area here is the bottle shop, which we understand trades very well. The darker area marked there is the tavern. And as part of the leasing deal, we're working with the tenant to do a refurbishment. They've submitted their development approvals for that, and that should commence. So we're starting some plant works around September, October time, and then the main works will commence in the new year in January. So has taken a little bit longer to get there than we'd hoped, but we're definitely on that journey. And as part of those plans, there'll be in this area just coming in here, there'll be an extended beer garden with sort of that alfresco modern feel to update the pub. And that's all helps. All part of that deal has helped increase the income, and hopefully on completion of those works, while we've already had an uplift in value, we're hopeful that will certainly present well for future valuations. There is a small part there highlighted orange. We have 3 vacant tenancies. We've had a few near misses on leasing those. We could have leased them to some tenants that probably wouldn't add anything to the centre, so we are being a little choosy. But certainly we're hopeful we'll lease those in time, and we hadn't put any value or income on that in the original assumptions when we purchased it. So anything we can get there will be upside to the income. So moving on to the sort of second value add asset we have in the fund, which is over in Queensland. This is southeast of Brisbane. It's a neighbourhood sort of small shopping centre really, that just has that amenity for the locals. We took a bit of a vacancy risk on this, purchasing it with the sort of main anchor corner tenant vacant. There was quite a short lease profile in the centre overall. What we have managed to do is lease up the vacancy to a good general practice medical centre on a 10-year lease, extended the lease with the pharmacy who was adjoining that. We've also done a couple of other lease renewals with existing tenants. Really positive on the WALE, so that's extended the WALE to 6.6 years, and we've now got 400k per annum plus income, which is a huge increase, just under 90% from when we purchased it. And we're still looking at more options here, so we still want to sort of upgrade the centre in terms of its appearance a little, and we're also investigating some further upside to adding some more retail footprint. A lot of the work to date has given us the ability to pay a special distribution that we're intending to pay to the existing investors off the back of the increase in income. And as part of that, we've revalued the property at 6.5 million. We purchased it for 6. And so moving on to the other assets that are in the fund. These are more the income plus side of things. So the property in Lytton, also in Queensland, that's very near the port in Brisbane. It's a sort of last mile refrigerated logistics property. We really like it because we think it's under rented. There is 4 years or so left on the tenure, but we feel there's an opportunity to reset that lease before the end of the fund and increase the income, which hopefully will then be reflected in the capital value. And then the more recent purchases were 2 medical centres bought earlier this year. 24 Sundew Rise, which is a private hospital. We think we've bought that really well in terms of the yield being quite soft in a soft point in the market, and we also think there's opportunity to increase that income with a market review upcoming. And in South Bunbury, a general practice medical centre we purchased as well. It's got a fairly long WALE. We think, again, we bought that at quite a soft yield in the market. By the time we sort of come to the end of the fund, we feel like we should be able to get some yield compression, and we're also working with that tenant to make a few improvements to try and also get a little bit more income stream there. What it does do in terms of the fund as a whole with the value add assets and the income, it gives us a really good blend. Certainly gives us that mix of growth and income that we've been looking for in the fund. With the new asset coming in Magnesium Drive, we hope to add that value as well. But it also gives us a platform potentially to look at a few more value add assets going forward in the fund. We did have a mandate to go up to 100 million. Certainly we're conscious of how many assets we put in here, but if we can find the right assets, there's opportunity to put a couple more assets in. Thank you. I'll hand you back to Brad.
Thank you, guys. I appreciate that. It was really well run through to everyone. What I will be doing now is getting through to answering some of the Q&A. So thank you for those who have already put your questions through before and also now. I see more coming through as we speak. Just a quick reminder first, we are recording this, and so we'll be sending everybody a recording afterwards. So do not need to worry about that. And as I mentioned at the beginning, the full information memorandum, or IM, we will be sending out around about the 6th. However, you are welcome to contact us before any of the key relationships team, and we're happy to help you through it. All right, now let's get into the Q&A. I'll just start with one that was asked first. One that is probably one of the most common questions we get is around co-investing. I'll give this one for Damien here. It's asked if any of us personally invest in the fund, and of course, it probably goes to our brand promise. Damien?
Absolutely, Brad. Yeah, so all our executive leadership team are eligible to invest in the fund, and many do. But the business as a whole invests in all of our funds, and that's part of our mandate. We want to be co-investors as well, and so so many in the leadership team will have invested, and not only that, the business will have invested in the fund as well.
Excellent. No, that's great. I'll get to some of these questions that have been asked. So first of all, why is the new, actually, I'll give this one to Damien as well. Why is the new fund opportunity only open to wholesale investors?
Thank you. Look, there's a regulatory regime that controls financial services licenses, which we hold. We hold two financial services licenses, and ASIC is the regulator. But not only that, they also, under the Corporations Act, specify certain conditions and what's required based on whether the offering is to a retail investor, which is anybody, or whether it's to a wholesale investor. So one of the good things about retail funds is you get lots of information, and it's but the challenge with that is the compliance costs are very high. So all the additional compliance costs means that typically, in our opinion, unless a fund is going to be targeting now around 150 million plus, then it doesn't make any economic sense to run it as retail. And the unfortunate thing about that is it does cut some investors out by only offering them as a wholesale investment. But nonetheless, that's the decision that we made. And so this particular fund, given the size of it, it won't be 150 mil. We thought, based on the assets as well in it, that does carry a bit more risk. We wanted investors who are a bit more comfortable with that risk, and given the compliance cost, that's why we chose to issue it as a wholesale only fund.
Excellent. Thank you, Damien. I'm just going to try and bundle a few together here, and this one will be for Alex Lambert. One of them is talking about, when you say distribution of 6 cents per unit, what is the value per unit? And along with that, there's a similar one on how's the net asset value of the fund determined. Are you able to cover off on those, Alex?
Yes, sure. So the 6 cents per unit, it doesn't necessarily link to the value of the unit. There have been, so at the end of June, the value of the units was $1.04. It has been up to $1.08, which I think some of the previous IM raisings were. We're projecting for the latest raise the unit price to be at $1. It will have come down slightly because of the special distribution being paid to existing investors. So effectively going back to them on some of the performance to date. But we also amortize the purchase costs that do trickle off. But as we increase the value of the assets, we're projecting that unit price to grow over time.
Excellent. Thanks, Alex. I've got another couple here, which for Alex Lambert again, of similar vein. One is around what is the exit process for investors, and the other one is around any future plans on listing the REIT. So I'll let you know straight away it's not a REIT, but I'll let Alex Lambert cover off on those. Alex?
Sure. Well, as you say, Brad, yeah, there's no plans to list this fund for a REIT. It's not that type of product. It's a wholesale unlisted fund. For the outset of the fund, where we're targeting a 4-year term, which takes us to around June 2027, and all being well in the market, we'll look to divest the assets on or around that time. Sometimes it can take a bit longer, but that's the target. It's certainly what's in our current financial models, is that we look to sell down the assets and return the proceeds by the end of June 2027.
Fantastic. Going back to Damien, there's a couple ones which I believe we've covered in there, but if you can just briefly touch on these as well. The first one is the projected 10 to 12% IRR per year return or total return for the whole investment period. And a second, more simple one, what's the monthly income payment?
So the internal rate of return, or projected total internal rate of return, is the expected return per annum based on the time value of money. I don't want to get too complex here, but basically the way internal rate of return works is $1 you get paid today is worth $1 more than $1 you get paid in 4 years, simply because of the time value of money. So in a nutshell, we're working on the basis that we're going to be distributing that 5 to 6% distribution through the life of the fund. Doesn't mean that there won't be some special additional payments. So Alex mentioned one there, that we've got 4 cents a unit coming back to investors through some value uplift we did on one particular asset, but the majority of the capital above that will be at the back end once we start to sell off those assets. So I'd work on the basis you're going to get 5 to 6% through the journey over the next couple of years, and then towards the back end, get your capital back. That's the target, to get the capital back plus some capital growth on that, which will make up the balance of that. So without getting into the complexity of discounted cash flow, that's basically, we would expect the balance of your expected total internal rate of return to be closer towards the end when we sell off those assets. And sorry, what was that other question, Brad?
I think you covered them both, actually.
Okay, all right, good.
Give me a sec. Just the monthly income payment. So it was, that 4 to 6 cents that you were talking about.
So at the moment, the distributions are monthly, and at 6%, or 6 cents a unit, that'll be 0.5 cents a month. So if you had 100,000 in, you'd get $500 a month, which will be $6,000 for the 12 months.
On the income side, yeah.
Correct.
Okay, I'll go back to Alex. Just a big one around interest rates. So what are the interest rate projections being used, and how are they incorporated into the fund's projected IRR? And also, if you can also touch on what would happen if an interest rise occurred, and how would that affect the investment?
Yes, sure. So look, as a company, we do monitor interest rates, and Alex Donkin, our CFO, has a sort of consensus rates from the big four banks that we try and adopt in all our cash flows. So they do change a little bit. Obviously, it's been quite an interesting time in the market over, longer than the last 6 months. But the rates we've adopted that will be in the IM that we're coming. So for FY25, we're looking at 5.9% as an average interest rate across the assets. Then beyond that, 5.15%, and then dropping to 5% the following year. So that's our projections. So what happens if they vary slightly? So for every 0.25%, 25 basis points shift, it would affect your IRR by about 0.2. So if they were running 25 basis points higher than our projections, the IRR would come down by approximately 0.2. The way we've run the model at the moment, we can absorb, if it was a 25 basis point increase, we can absorb that within the cash flows and wouldn't necessarily need to change the distributions. I think if there was a significant surprise in the rates that went much higher, then we'd have to revisit it. But certainly at the moment, we've got a little bit of wriggle room within the cash flows. But yeah, if the markets were to suddenly change and go off in a direction that none of us could foresee, then we would have to review the distribution rates.
Love it. Thank you. Well answered. I love Mr. Wiggle Room there. He's always factored in extra contingencies in everything he does. I'll go back to Damien for this one. It's an investor I'm sure would know us well in this case. Will the target IRR equal or greater to 12% be applicable to new investors as well?
So the target return is 10 to 12%. And certainly, if you come in at this stage, we're still forecasting based on where the fund sits today that we are still going to be on track even for new investors. Obviously, 10 to 12% from this day forward, not obviously back over since the fund's been running. But yes, we are still targeting in that range for new investors coming in based on the assets we hold and the assets that we're purchasing.
Fantastic. Sorry, Simon. It seems to be all questions for everyone else. You've covered the asset too well. Another one for Alex Lambert here. I'll bundle two together, actually. One is, what are the asset management fees? And a very similar one is, what is the fee structure of Westbridge?
So the asset management fees is 0.75% of assets under management. So the returns are a net of those fees. We do have acquisition fees on the way in, and there is a performance fee at the end if we outperform 11.5%, I believe it is, on this fund. And so that's generally the fees that you have. But the returns we are stating are all net of those fees.
Excellent. A couple here just in regards to, actually, I'll get Damien to cover off on these two. First of all, are the returns on investment guaranteed, or the investment principal guaranteed? And are the returns on investment tax-free? If only we should all be so lucky. There you go, Damien.
I wish. Now, I'll start with the first one. No, definitely there is, principal is not guaranteed. I think if you want guaranteed income in this world and principal guarantees, you're probably best to look at government bonds, where the government's most likely to pay you back. But obviously the returns are a lot lower. This, like any asset, it does involve risk. We certainly believe that we've purchased assets well, that we're doing the right things to value add to those particular assets. But of course, anything can happen in this world. So no, ultimately the total return that you would get would be based on what we sell the assets for, and plus those distributions that we've spoken about. So it is not certainly guaranteed. The investments are not guaranteed. In relation to investment tax-free, I wish it was. But like all things, there would be tax to pay, but that'll come down to your individual circumstances. So there will be, as we do have with a lot of real estate funds that we manage, there is just a depreciation allowance within those particular assets, depending on the age of the properties and the original construction costs. So some of it will be tax deferred, and meaning that even if you got, say, yours 6 cents a unit, say 6,000 for 100,000, not all of that would be necessarily taxable. Some of that would be tax deferred, meaning it comes off your cost base, and that would not be realised until the end of the fund. So you would expect that at the end of the end of the fund, if there was obviously some profits on the sale of those assets, that they would be subject to capital gains and the appropriate capital gains discounts depending on the investment structure that you've used. Of course, as we know, Brad, many of our clients use super funds and are in pension phase. So assuming they don't have the very large amounts that the government's targeting at the moment, many of them are in a fortunate position to benefit from a tax-free distribution based on the pension phase. But look, ultimately, the income from us would be taxable to some degree, and you would then obviously need to look at your circumstances, whether your individual investment entity has the ability to minimise or reduce that tax payable to nil.
Excellent. And I guess the moral of this story is make sure you set up your correct funds strategies before you invest in the entity. Talk to a very good accountant. And of course, just bear in mind that, yeah, you might get a rather big profit. So you don't want to be putting it somewhere where you're going to lose it all in tax. Going back to Alex, just some easier ones for you. What's the gearing of the fund? And what's the valuation per unit pre and post raising?
So gearing, we're projecting following the sale of, following the purchase of magnesium asset to be around 53%. And sorry, what was the second question there, Brad?
Sorry, what's the valuation per unit pre and post raising?
So the latest unit price is projected at $1. We're just finalising those numbers for the IM at the moment. And I mean, it will still be $1 post-purchase. As I said earlier, we do amortise all the purchase costs. So they do roll off on a sort of monthly valuation basis, which will slowly bring that down a little. But then as we work through the assets and revalue them, that will be offset by value increases. So yeah, immediately afterwards, it's still effectively a $1 unit price, but it will fluctuate over time.
Yeah, so just to reiterate, for anyone who wasn't clear on that one, we are paying a special distribution back to the existing investors in the fund to get some of that profit out to reduce that unit price back to $1 for the new investors coming in. Another one that's very related to it, if an asset, sorry, Alex Lambert, if an asset is exited or sold for a profit, i.e. capital gain on the unit price, how are the profits distributed to the investors? And maybe Damien on that tax side might need to cover anything that's not covered.
Sure. I mean, on the unit side, all units are equal. So if you're a unit holder, the sale proceeds from that asset get distributed evenly per unit, depending on what that rate is. So that's pretty simplistic in the way the fund's set up. And I'll let Damien jump in on the tax side of that.
Yeah, so look, we would anticipate that the profits on the sale of the assets would be a capital gain, and as I mentioned earlier, then that would be distributed through as a capital gain, and then that would be obviously up to then the individual investors to determine what entity they held that particular investment as to the amount of tax they would pay on that. But generally, for individuals and trusts, the capital gain is discounted 50%. It isn't for companies. And then, as I mentioned, self-managed super funds and self-managed super funds, depending on if you're in pension phase, might see 10% or even 0% tax on any profit there.
Fantastic. And then a final one, because we are going to run out of time here. Sorry, there are quite a few more still coming through. We will answer all these offline. Thank you for putting your names on them. Damien, is Westbridge a regulated entity under any act? And as part of that, does the fund meet the ATO public offer test?
So yes, Westbridge is a regulated entity. We're regulated by ASIC, the Australian Securities and Investments Commission, and we hold Australian financial services licenses, which allow us to generate and investment opportunities for clients, and even obviously those investment opportunities that we're talking about today are covered by a wide range of regulatory matters under the Corporations Act. So in terms of, I think the question was, is it a public offer? Look, public offers are generally only relevant in this context that is more around debentures. If you're asking, are we a public trading trust? The answer would be no, because it's the fund is not in the business of running a business, making profit. Some of our development funds are considered public trading trusts, and then they're taxed at the fund level and then paid out as a franked distribution. But I'll just get that person who asked that question just to give us their details, and I'll get either myself or our CFO to give them a call to clarify exactly what they're asking for, whether they're more around public trading trust or is it offshore taxation to non-residents.
I would suggest it's the second from some of the other questions coming through, but that'd be great. We will answer that separately. I will actually answer one last one. I know I said that, but this one's quite a common one that comes across around what's the target end date of the fund, and will capital be returned as assets are progressively sold or at target end date? It's a 4-year fund. It has been going for 1 year already, leaving 3 years left on the fund. We will be progressively selling down those assets, and as we sell them, obviously, paying back whatever debt we need, the remaining cash then does get distributed out throughout the fund back to the investors. We've got a big belief that money is always better in your pocket quicker rather than sitting in ours. So yes, it will not be waiting until everything's sold at the end. It will be sold and returned back to everyone. Thank you, Alex, Simon, and Damien, for your time. Well done. And thank you to everyone. We will endeavour to answer all the rest of the questions that haven't been covered. And yes, look forward to the 6th of September where we'll send out the IM. Thank you, everyone.